Hi everybody, I'm here with Eric Cyrenne from RBC. Eric's a very well-respected mortgage specialist in the West Island here, and he actually covers all of Montreal and surrounding areas. We're here today to ask Eric a few questions about some of the misconceptions out there regarding mortgages. I think we'd like to start with possibly talking about pre-approvals, Eric, because that's something that we in our business deal with all the time, representing buyers and sellers. Often we'll be representing a seller in a very hot market as we're in, and an offer might come in, and we ask the realtor, has your client been pre-approved? It's usually the number one indicator of a strong offer is having a buyer that we know is qualified to buy the property. So Eric, we often see this word being thrown around, pre-approved, but actually I think you and I have both experienced this many times when actually the client isn't actually properly pre-approved. They've been pre-qualified. Can you explain a little bit what the difference is between like a pre-qualification versus a proper pre-approval where somebody has a letter in hand?
Sure. A pre-qualification is basically when the client calls their bank or mortgage specialist and verbally gives him their information, which most of the time can be inaccurate. A proper pre-approval is when the client has submitted his income documents, his proof of down payment, and the mortgage specialist has verified their credit to make sure there's no fraud, mistakes, or credit issues. And then the mortgage specialist actually submits all of the documents to the credit center, and then a pre-approval letter is issued once everything has been verified and approved.
There you go. See, big difference between getting on the phone or walking into the branch, speaking to somebody quickly, and they look at your overall general financial situation and might say, yeah, you should be good for your mortgage, versus actually going through the process of getting all the paperwork and having the proper pre-approval done with the credit check through the credit center. Then I know Eric will provide that buyer with a letter, and when I'm representing a seller and that offer comes in with a proper pre-approval letter stating the amount that client is able to purchase, that might be the deciding factor between my seller accepting one offer that's got a proper pre-approval versus another offer where maybe we've just been told that the client was pre-qualified. Having that letter is very powerful, especially in a hot seller's market. Another really, really important one, and this is something we hear all the time, is we get buyers who are very focused on what is the rate. Mm-hmm. I'm sure you hear that all the time in your business. They're shopping around with different mortgage specialists or different lenders, and they seem to be very rate focused. Can you explain a little bit more about what would be some of the things to look at when you're comparing two different lending institutions, not just the rate? What are some of the other important factors?
What the clients don't realize is that they should be comparing, like you said, apples with apples. Many products are different. They want to make sure that what the product that they're taking is a flexible product because their situation might change. So,
can you give us some examples?
Yeah, sure. What's important is to make sure that the mortgage is portable.
Okay. What does that mean?
Portable basically means that if they sell their home within the 5-year term, they can port the mortgage to another home, which is very important. Many of my clients use that benefit. And
I see the benefit there because we get a lot of people who think they're going to buy their forever home and be in there for 20 years, and often life gets in the way and things change. They outgrow the home. There are tragedies like divorce or death, and sometimes job loss, job transfer, and people have to make that move. So I've had some instances where clients have been locked into some major penalties based on the fact that they've had a long-term mortgage.
Yeah. I had a pilot from Ontario being transferred from Air Canada from Ontario to Montreal.
Yeah.
And he told me the 0.5 that he saved off of the mortgage rate was the most expensive
0.5 saving ever.
Yeah, exactly. So basically he was with a virtual bank and they weren't allowing him to port. So he ended up having a $7,000 penalty, and he had saved, I think he told me it was like $14 a month.
So when he took that initial mortgage, he went with that product because it was
the cheapest at the time.
A little bit cheaper rate per month, but on the back end, when it came time that he had to sell his home,
a costly mistake.
Very costly mistake. So there you go. That's a big one. Looking out for the terms and conditions of a mortgage, not just the rate. Would that be fair to say?
Yeah, exactly. Another benefit of getting a flexible mortgage is making sure that the mortgage is assumable. So meaning, if ever you sell your property, the buyer can assume your mortgage. So when in a climate where the rates are climbing, it actually becomes a selling feature for the home.
Absolutely. Yeah, that makes sense. For example, rates right now are almost at historic lows. So if rates were to climb up 1 or 2 percentage points, I can see that being able to assume a lower interest rate would be a huge selling feature, would actually help somebody sell their home.
Yeah, exactly.